I think there's a genuine resetting of the scales where a lot of the operators and first-time buyers, they should have really good information so that we don't put people into a position where they're losing money by buying bad sites. One of our big company goals is to democratize the data, but make it more transparent so that you never develop in an area that you shouldn't be developing in. And in a second, we will show you the 10,000 facilities in the United States that actually fit that criteria with the owner information. And now you can create an off-market acquisition strategy that actually fits your thesis.
What's up, everybody? Today, we are talking about the data that you need or the information that you need to get when you're trying to find a deal. So when you guys are out looking for an acquisition, a deal, should I buy this? Should I not? What is the important data? Like, what do you need to get from that market? What do you need to get from that facility to know if there's demand there, if this is the right thing that you should be buying, or if there's danger, or if you're not seeing it correctly? This is a big hurdle, and a lot of people don't even know where to go to get this information or what the important information is. So today, I have an expert on that, and I'm really excited to talk data and information with someone that sees it all quite literally. So Noah, how's it going, man?
It's going great, AJ. Thanks for having me. Excited to chat about storage and data and all of it.
You have played both sides of the fences here. So you're not like a normal vendor, because obviously you started and own TractIQ, but you didn't come straight from a software world. You came from the other side, my side of the table, right? And now you play kind of both sides. But talk to me about that. Like, how did you go from being a storage owner operator to then TractIQ and seeing all this market data and building the software system out that shows us all this information, what's really happening on the ground?
I love it. Well, thanks for having me again. And you're right. I came at this not from a technological lens, but more from an investor side. So my first foray into self-storage was back in 2018 when I started out on the financing side. Actually financed a handful of ground up construction projects that we turned into CubeSmart and public storages. Yeah. And like a lot of your listeners, I learned then how resilient self-storage has been throughout cycles, how it's an investment in American dynamism and mobility, and it made intuitive sense. I then also worked on the equity side, working for a large private equity company in the residential space. But in April of 2022, which is now about 3 years ago, I was super burnt out in the corporate world. I was working very long hours. I didn't have control of my own destiny. So I left my corporate job the same week that I bought a house, the same week that I got engaged to my now wife, and the same week that I bought my first self-storage property. So I don't encourage any listener to throw it all into 1 week. But
I love it. If you're going to do it, dude, do it. And you did it.
I dove in, but my goal was to build a diversified real estate investment company in self-storage.
Yeah.
So focusing on value add opportunities in undersupplied and growing markets, trying to leverage data to find good opportunities. And we built a portfolio of 700,000 square feet across the United States. And I had major pain points, which led me to TractIQ that I can go into, but very much came at this from an institutional investor lens, not the technological side.
So talk to me about that real quick. What deals did you buy? Why did you buy them? What were the things that attracted you towards them? Like, how did that go? I mean, it's one thing to be on the corporate side because you're part of a bigger machine. So it's like you get all these things, right? It's help you don't feel alone doing it. But to go out and be like, it's just me and I've got to make this decision. It's amazing how often just having a confirmation from other people makes it much easier because they can see it. When you're on your own, though, it's all on you. Mm-hmm. Like, what drew you to those first deals?
And I think a lot of people like the comfort of a big company to protect them in a sense.
Yes.
But I learned a lot at big companies that allowed me to feel confident and have conviction around opportunities. And we can talk about...
I did the same.
Yeah. And we can talk about how to leave your corporate job to, buy your first storage facility, which I'm sure you do all the time. But I knew in my gut that if I found a self-storage property that was located on a road with good traffic counts, it had low saturation of storage in the market with positive rent trends in the area, good median incomes, strong population growth, new housing coming into the market that would lead to future self-storage demand, and was bought at a fair price, I knew that we can take that opportunity and raise capital because I had been on the institutional side and I knew what they looked like. So I think it's finding those deals are really hard. But when you find one, there's obviously bringing in new partners. There's making sure you're going to get the management side correct and all those things. But there is data that all institutional investors want to see. And if you find a site that checks all those boxes, you'll be able to raise the capital, at least is my view.
It's interesting you say this because I'm like, really, everybody, when you are trying to do any new venture, but let's say it's go into a new market, anything, there's really three ways that I look at it that I'm like, these three ways are how you can do this. You can either do it on your own, just figuring it out, right? Which that's how we started in storage. It was like literally, this is back. There's no information. Nobody out there. We didn't know anybody. It was like, bought it and just figure it out. And then bought another one, figured it out. That's hard. I don't suggest that. Like at the time, there was no podcast, social media. We didn't have anything. There was no masterminds. There was no self-storage income where you could go join and learn how to do everything and get none of that. It was just like, hope we don't screw this up. So it was very much basic things. It was just look at the asset, understand real estate. At the time, we didn't even know what cap rates were. We didn't judge it like that. And so it was really hard, and our lessons took us years to learn. And so what it took us to do in 15 years, I did in 5 years after that because of that learning cycle. So you can either just rough it, do it yourself, or you can learn from others. And when I say learn from others, I mean learn by doing with others. That is, you partner up with groups that know how to do it. You work for somebody that can do it and you learn like, you did, or then you just have the basic information, mentoring. Those really are your three ways to try to condense learning. The first one has way more risk. When I got started, we didn't because they were 10 caps. Like the risk was way less and it had to make up for what we didn't know, but nobody wanted storage. So you were buying at 10 caps. The cash flow was stupid, right? So it was like, okay, even then though, that was scary because you didn't have the information, but that afforded us to make mistakes and learn. The second one, like you said, that you mentioned, I love it when people do this. And I did this in everything from mergers and acquisitions to I learned all this business stuff that I then would take and apply and utilize. That also provided me not only with the knowledge, but experience that I could then transfer and use. And then obviously the third way is getting help and learning, educating. Hence the reason why we do this. We're trying to allow for that because lots of people may not have that opportunity in number two, right? Or they also may not be able to do number one because they don't know how and they can't get the resources. So your experience, right, I tend to find very much a main way that people do this. So if you went to like the REIT, something like that, they go off and they start their own things. It's pretty standard.
Charlie Munger said that you're shaped by the 5 people that surround you the most. So I would argue I was not just number 2. I was 2 and 3. And, just because I came from a great institutional background, I had wonderful mentors who had done this before, who were willing to support me. There was one of my mentors I've had for the last 6 years when I was raising capital for the first time. I did my underwriting, I did my projections, and he was like, well, how you can validate all of your underwriting is if you go get 3 really good experienced management companies to give you their projections and then show how conservative you are. that to me was a brilliant point that
Yeah.
I wouldn't have found on my own if I didn't have really good people in my corner.
That is such a hack that we teach. I'm like, you want to know, go get management companies to do the underwriting stuff, bring it back to you. And that should give you a high-low range of what you should know. That tip alone right there, that's huge. Like, you do that and you're going, that's like, I got institutional knowledge to come to me to present what they think. And then I got multiple versions of it to show me the missing gaps in my thinking. For everybody listening, that's an absolute gem right there. Take that to heart.
Now, there's some problems with everything I just said, where to me, the real estate world has this checkbox of things they look for, but I don't know of many people who have actually looked at the relationship between these variables and success. So this was the thing that we started to do on our side, and we were a small fish in a big pond, right? REITs and large institutional groups, the consolidation has been massive over the last decade, as you well know. And there's been this competitive advantage in data that I didn't have, right? I had access to Google and some free resources and some other resources. But to me, I felt like I was missing the picture in storage. And that led to us missing opportunities. And all of this kickstarted an effort to actually build our own data tool internally to find more deals with data, but then making sure we're analyzing a complete picture of a given opportunity. And most investors today are at such a disadvantage when it comes to that.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description. This goes back to the point where I started talking about this at, I think, ISS and SSA way back in the day, because I approached from a business side. I wasn't a real estate person at all. I was a cash-based business product. Like, I didn't do real estate, nothing. So we're buying these properties and everything. And my thesis was, this is a business, not real estate, right? And that's what I wrote the first book about, was turn a real estate asset into a thriving business. That's my entire thesis. That's my business model. That's what we teach people, right? And when I first started talking about it back in the day, I remembered it was interesting because the first time they had me speak on it, like a bunch of people got up and left because I think they thought this is the stupidest thing I've ever heard. Like, no, it's a real estate asset. Location, location, location. All you do is take benchmarks, right? And so it was stupid. But then as time went on, particularly as the internet, everything came in, it became, huge rooms would be filled. And it was like, all right, this is not only a real thing. They realized that playbook is changing. And I think there's 3 evolutions of storage. We had storage in its youth, like its infancy, and that was real estate. Then we had when it became a teenager, and that was principally when the internet came in. And then we had 2008. Teenage years are one of the shortest part of your lives, right? So that was, we map it out as right around 2006 to 2019. That was its infancy, right? That is where you have to grow up and realize who you are, right? That's when storage started to go, no, this is much more of a business. We need to look at all this stuff. The next phase is maturing, and that is a data phase. And this is why I believe your role in the industry is so vital and important, because what happens after that adolescence phase, people that get good and they have the information, once you go into a matured phase, they can compound out the returns. We were terrified in the early, after 2008, that storage was going to become like hotels. You were going to have 4 brands that owned 90% of everything, the whole entire market, because they could use leverage on information, technology, data that none of us could, even huge operators, like hundreds of millions of dollars. That's why we started Store Local. And that did really good. But then we started to run into problems where the competitive advantage was data. And we're like, we wanted to allow single operators to perform. You are the solution to these problems that single operators that benefited us hugely, Store Local coming together, getting information max. But then once data started to come out, public storage, all these others that are great at what they do, because they could use their internal data, it was all connected. And that gave them a competitive advantage, like Extra Space, that made them blow up. Extra Space, that's what they did, right? You answer that for everybody, though, coming in. So like we were doing that with Store Local and Tenant Inc. and Hummingbird. It was you own your data. We're democratizing storage. But no one had done that, right, really, on the market side, that front end side. And then we had some people like Radius Plus and others come in. And what we loved about what you're doing is it's that on a whole new level. We have not seen information that we get from your site. When you were buying these deals, trying to analyze these deals, like, so when you were trying to get this information, how are you going about it? Like, how were you trying to get information that you needed from a whole bunch of stuff that we talked about earlier that you can't even find or see? How did you do that?
100%. I'll say one thing because you mentioned hotels. Hotels actually is an industry to look to now as something, as an industry that I think has done a good job of making the data more transparent. They have Smith Travel Research reports where all the big hotels actually aggregate their information every day. Anyone can go buy a report. Yep. Doesn't matter how many hotels you own. So I think that's something we should strive for. In terms of, as an investor, we had massive pain points. If you wanted to know new housing coming into a market, you had to call the city, get a hold of someone, and they had to either provide you the information or tell you over the phone what's going on. You had no visibility into who owns it. Can you call the developer? How many units? When does it deliver again? What's the cost? What about all the new commercial headquarters or all the new Walmarts or retail locations opening up? Yeah, I mean, the big headquarters like in Texas with the new Texas Instrument plants and the new Samsung plants, you'll hear about it in the news, but that isn't applicable to your hyper local market, right? Your 5 or 10 mile radius of your site. You still want to know, you should know what's going on, what other commercial demand drivers are factoring in. So these are data sets that would take hours. And the problem that we've found is it's too slow if you want to win a deal. If you want to win a deal and be able to submit an LOI and come in with confidence and conviction, you don't really have much time to call the city, to get a walkthrough, to go do all these things. You need to be really efficient and quickly understand if a site is something you want to buy and if it's something that would work for your investors. So that time to realizing that data sometimes would even lead to bad decisions because you might think there's a lot of new demand coming into the area because your broker tells you or someone tells you, oh yeah, that area is on fire. You're like, cool, can you quantify that for me? And so we spent a lot of time trying to figure that out. And it kickstarted an effort to build our own tool internally. And we're a young, small investment group. You don't really have the resources that you're competing against. So we actually found TractIQ on page 10 of Google when we were in this whole phase of trying to license data. And TractIQ was built in 2021 by a data company and for a guy named Tom Hallaton. And right when it was built, Mr. Hallaton unfortunately passed away. So we kind of like in storage, we found this off-market opportunity that had a really sad circumstance. But when we asked to license data to build our own thing, I was actually blown away by the product and realized, okay, we can actually use this for our own investment company as a competitive edge. And the greatest part about that is that we realized very quickly that it's actually bigger impact for us to share this with the rest of the industry at a really good price point and allow everyone else to gain the same or similar edge that all the big REIT institutional companies have.
This is a important piece because you and I share this philosophy a lot. Like we talked about, our internal brain, as we call it, that does all of our equations and analysis and everything that we built over 20 years. We needed that as a software product. So I've spent the last year and a half building it, and we're actually going to give that to the market here in the next couple months. But it takes in everything we know and how we figure out pricing, all sorts of stuff. And this is what we did, that same thing with Store Local. We took what we were doing and we sent it to the market to democratize it. And one of the people, I think a lot of people would say, why would you do that? Why would you give your secrets away? It is 100% selfish. It's self-driven, because if all the big boys own all the properties, I don't have a business. So we need there to be a vibrant market of different layers of ownership and everything else that can survive, do good, so I can buy, so I can build. Also, in storage, the number one thing that hurts storage more than anything else,
New competition.
self-storage. Exactly. So I want everybody to do a good job. Like, I want everybody to do two things: raise prices on rents and build to the market, not overbuild. Because if my neighbor, if the guy across the street is at 50% occupancy, that doesn't mean I'm winning. I'm losing because there's no demand in the market, right? So that is very much a driving reason that we're like, we all need to do good. We need to do better, because markets were getting, especially back then, a single market would get overbuilt and it would be destroyed for years. And people didn't have the information. They didn't know. It was literally somebody just had some land, and so they built it. And when you went to find out data or information, they didn't have it. They didn't even know where to go.
This is one of our big company ideas and what we're fighting for, where you compare real estate to the stock market. Really, let's focus on self-storage. Right now, I would attest that most investors invest in storage based on peripheral metrics, because we don't actually know the true performance of local markets. We don't know occupancy. We don't know achieved rents. We don't know customer length of stay. We don't know ECRI schedules. We don't know demographic profiles of really where the tenants are coming from. We think we know within a 3-mile radius or a 10-minute drive time, but we don't really know. And you go back to hotels, right? How much more efficient the market is. Efficient also means good, right? Because to your point, if I'm a developer and your site's 50% occupied and hasn't leased up in 2 years, I should not build near you. Not because you don't want my competition, but because I'm going to fail. And if I fail and you fail, then we all fail. And then we create a bad experience. We have communities that are suffering because we have vacant storage buildings that could have been used for a better, use case. And if you actually think about it, this is where being a fragmented industry hurts us.
Yes.
Because we are all very challenged to share this information. And it's hard to trust someone to actually, here, give my information. And
absolutely,
it's really challenging. But all of that is one of our big company goals, is to democratize the data, but make it more transparent so that you never develop in an area that you shouldn't be developing in.
Yeah. The big boys, they can get data that we can't. So their development projects and things, I think, tend to be much better and probably have lower default rates than the rest of the industry. And it is because of that. When I look at a market, there's 3 things that I need to understand. There's 3 markets within one. And this is something I teach a lot. It's really important for you guys to understand. The 3 markets that make up the market that we look at or underwriting is, you have the people, you have the actual market of business, and then you have the market of storage. So when you're looking at demand within a city, you are not just looking at occupancy and rents, right? Because the storage industry, right, that is supply side, which is obviously really important, because that's the one thing that in storage particularly we affect, and badly in some cases. The other side is the business market side, the actual industry. What is going on? Is one shutting down? Is one coming up? Those are forces that are non-controllable. So that to me, this is like black and white stuff. You don't mess up on this because it's black and white and you have no control. And then the people demographics, and that has to do with, you have an idea of what you're going to charge for rent. Can the people even pay it? Are there going to be more people, less people? Where are they going? How are they going? Like, there's so many times that people look at a market or they look at a location they're going to invest in, and all the information that is predicated is this is a growing area. It's very surface level. And what happens is they didn't understand how people were moving in. The big reason this is important is because within storage, we have individual markets. We have a 10 by 10 climate controlled. We have drive up. You have enclosed parking. These are different customers. There's actually different supply demand for each unit type. What that means then is if you get the people wrong, you're going to build wrong products for the wrong customers, even if the location was right. So these three things, what you look at and what your software does for us is it takes each one and it overlays, because it's not only do you need to see it, but I got to see the correlation to understand what does it mean. So when we're working and looking, that's what we're looking for. With that, what are the main points that you see if you're going to go into a market, if you're looking to buy storage, what are the main things that you use TractIQ, or I would, to say this is a good deal or a good market, or two, you need to stay away from?
Well, I'll tell you what I'd say 3 to 5 years ago, what people would do. And I remember there was a constant saying that only rents matter. Did you ever hear this?
Yep.
Yeah. Only rents matter. And I would say over the last 2 years, what's a market rent? How has the rent conversation been in self-storage, right? And how much of a black box is rent now, where street rents are felt like meaningless, web rents are now the thing, but you know that web rents aren't the true rent that the customer is going to pay in 3 to 6 months.
No clue. People have no clue.
No idea.
No idea. And for everybody listening that doesn't understand what we're saying, when we say this, what we're talking about is you may look and say, oh, a 10 by 10 is on their website for $50. But their customers, like with most of the REITs, they may be paying $150 in place because street rates became teaser rates or special. So just by looking at what the rates are, that actually does not tell you what the people are actually paying. So you don't know what the revenue is, and you don't know what the people inside are. There's different economics for people renting a storage unit versus staying in it. And those economics are dramatically different. So the elasticity of that decision to rent a storage unit is driven very much on price. Once you're in it, it's very inelastic. And that price value changes dramatically. The economics of it do. And so what they found is those are two different rates. So what we're talking about here is you look at a market and you go, all 10 by 10s are $50. So that means this guy who has, 10 is making $5,000 off those 10 units, right? That's not true. They could be 200 or 30. We don't know.
So my point is,
and that's new.
3 to 5 years ago,
that didn't
and
exist.
you could actually look at the rent and
you would
generally know what the market rent is. Mm-hmm. Today, it's a black box. It depends on the operator, it depends on the location, depends on a variety of factors.
Yes.
So what things actually correlate with high achieved rent per square foot, or high street rent per square foot, or occupancy? And we actually came out with something this week.
Not what it is. What are the things?
What are the things that correlate the most to this? And I would give you one metric you might not have heard, because I'm sure you've heard of median income, which is, I think if my numbers are right, has an R squared of about 0.35. And generally, for those who don't know what R squared is, anything above 0.7 means it's very correlated to the given relationship between the variables. Median home income, that's one, but it's kind of low correlated. Population growth might not actually be that correlated. So you have these traditional metrics, supply per capita, a really interesting one that we could talk about in a sec. But one that actually was surprisingly highly correlative was median home value. We actually found that the R squared was about 0.6 between median home value and street rent per square foot. And street rent per square foot and achieved rent per square foot are pretty correlative. So this is highly statistical, but generally there are lots of demographic and storage variables that correlate to high rent per square feet. And when you're thinking of an investment criteria of what areas should I buy, ideally, you want to find the best variables that match your investment goals and reflect the highest possible outcome for your storage facility.
I love this conversation. Sorry, everybody, guys. We're just like data nerds here because we look at this too. And one of the things with our brain that we were doing and looking at is the correlation of rent and rent growth, but also the correlation of move outs. So we call it, right, opportunity and sensitivity. So the opportunity for rent growth and how sensitive that rent growth is, and how sensitive that individual is. And those two things, what we found tracking information and doing it, we were very lucky because we had 2 million square feet that we just owned. So I could do a lot of things that you never could do with investors or anyone else. And that was including doing massive changes in rates and jacking up rates here and there. And then we would take and look at all of those things, who moved out, what, and then we'd take all these data sets and we'd try to find the correlation with it. Funny enough, they're not as simple as you would think. Like your example that you gave, medium home income has a lower correlation, but medium home value has a high correlation. These things that drive rent or make people more sensitive to rent increases, this is the new way we believe storage is being done. And it's something that we started doing a while ago, but it's really hard to administer. Now, how we're doing it is different, obviously than how you're using it, what our purpose is, which we'll share more later on once that comes out. But it's the same idea. We approach it the exact same way to get the objectives we need. I believe that this route that you guys have gone, and it's the route that we have gone, is the new way that storage will be done. And it's the new way of underwriting and figuring out rents, as opposed to simply the rents are the rents.
I would actually disagree. I would say this is the new way for non-REITs. Because REITs, and this is, until you really get into the weeds like what you do, all of these things have been known for years. Just because we found out about this this year,
the REITs know about
have known us.
Absolutely.
So you think about the disadvantage that we have all had in the industry. This is when I realized, I need to really go down this path because there weren't a lot of resources available for me as an investor. And how can I possibly compete with the bigger players if I don't have all of this data to arm me? And
bingo.
Now our goal is to your point, democratize data for the industry. And it is self-interest for sure. But I think there's a genuine resetting of the scales where a lot of the operators and first-time buyers, they should have really good information so that we don't put people into a position where they're losing money by buying bad sites.
Yep, exactly. This is that whole maturing of our industry now and saying, listen, data is king. It's really, really important, right? First of all, you got to understand when the rates dropped, right? What we saw, which was incredible. We saw 60% rate drops. Wall Street Journal came out storage rates are dropping 50, 60% in some cases. That year, I think the average was 25%. Now, to put that in perspective, in 2008 and 9, I think we saw a 7% drop. So we weren't even in a recession and rents did that. Let's take this even a step further. The average occupancy when rates in the nation dropped like that was 92%. When rates went down by 7%, I think it was all sub 10%, 2008, the average occupancy got down to 75.
What's even crazy about that, because you use rates and we're now super particular about what rate we're talking about, achieved rents for the REITs actually didn't fall.
Yes.
So this is a big headline in storage where, the street rent is down by 20%.
But the in-place rates weren't for REITs. In fact, they went up. They went up by 3%. So if you looked at the REIT, their street rate, $200 went to $60. But then they published their average rate and everything, and it rose. That was what blew everybody's mind. And the problem with that was they had data they could use. We didn't. I believe that it was partially intentional, where it was we know how to do this, we can. So we want to lower these rates because everybody that wasn't a REIT, holy cow, that hurt. Because the how it had always worked before in 2008, everything else, once you got a rate, you couldn't, that rate, you would adjust, but it would stay fairly similar. You would get 8% increase in the heydays, we were getting 12, 13, 14%, right, a year. And that was crazy, stupid. Like that was never going to continue. The REITs were tripling their rates. So their rent increase was 3x in 3 months. That had not only never happened before, mom and pops and even big players, we're talking people with 500 million in assets, $1 billion in assets. They didn't know how to do that and get away with it. They didn't know how to, like, they're like, everybody would just move. Everybody would leave. They didn't have the data to say these people will and won't.
And I think a lot of people in our industry, as we've talked about the struggles with storage over the last couple of years, because there's certainly been struggles because REITs are not the whole industry.
Not at all.
But, it's really under this guise of, well, interest rates are high, housing market's down, right? It's going to lead to lower storage demand. And there's truth into that.
Yeah.
But what has been missing from the conversation is no one really knows what's going on in storage.
Yes.
And so if you think of you're a customer, you think you're moving in at one price only to be paying a different price 6 months later, that's a bad outcome for the customer. Investors, what's market rent? How am I supposed to underwrite new deals? Take away, what my interest rate is, but how am I supposed to know what the projection, what I can do with this store if I don't even know what the true rent in the market is? And then the lender is asking the same questions. Well, how do you come up with this if the street rents are this? And then vendors and operators also have struggled to communicate all of this and provide services to help all of the groups actually make sense of what's going on. So I would say, yes, the macro challenges are real. And I'm not saying that those aren't, impacting the industry.
Overblown.
It's just part of the story.
Yes.
The other part is we don't know what's going on.
Yes.
And because we don't have a transparent data set that we can all look at and say, this is actually what's happening, we're all just scrambling.
Yeah,
and
pricing went out the window. It literally became, people were like, I don't know what to price. That shut down acquisitions. And that's where development started to shut down. I mean, so if you didn't have this information before, or normal people didn't have this information, it was just who you knew, everything else. Our Arizona development we had information because my partner was a senator, or a congressman. So we got information that we knew, but then trying to relate this information to a bank. So we're talking about your own decisions. Go to a bank and try to tell a bank that $100 rate that was $200 is fake. Obviously never going to happen. Not going to work. Because they're going to go, that's what the rates are. And so that just shut off financing. That shut down, everything. And so we're moving into a cycle now where I think 40% down development, something like that. And that's going to continue for years because of this mix up till street rates can go back up. It put value in pricing in a tailspin because of the lack of data and transparency. We didn't know.
And the good news, there was obviously legislation in California recently that initially started as a rent control bill for self-storage, where you wouldn't be able to change the move-in rent for the first 6 to 12 months. That kind of got pushed back where now you have to disclose what the maximum rent you'll charge within that 6 to 12 month period. That to me has changed the tune for a lot of operators, which to me is a sign of good news, where at the end of the day, if people are feeling like they're misled, if investors don't know what's going on, if you have a chaotic environment where things are at a standstill, this is where governments tend to come in and regulate, which I don't think anyone here is in favor of wanting the government to dictate how people should operate their storage facilities. But that's what happens when you have this lack of transparency. And thankfully, it doesn't look like this bill is too punitive. But my hope is that this message of transparency is actually felt by the whole industry. And we can go back to the price on the website is genuinely the price for the first year or so. And, we can all learn from this and never do something like this again.
Yeah, getting that transparency back. Mm-hmm. So I want to go back here real quick because we're talking about transparency. Let's get back to the signal. So a lot of times, we get very confused with the noise and storage. That's what we're talking about. There was all this noise, newspapers, everything else, that everybody was confused. Nobody could decide what the signals were. So when you're talking about transparency, right, it's like, here's the signal, everybody. Ignore all this other stuff. So when you were looking at these things and trying to understand these signals, you talked about home income, home value. What are the other ones that you looked at that correlated to good, healthy markets that you would say these are the signals that we look for, either good or bad?
Yeah, so I'll answer this from the public data side because there's private data that we wish we had. But on the public data side, the last and probably most controversial metric in storage is supply per capita. And for those not familiar, it's a saturation indicator. It's basically you look at the amount of people in the area relative to the amount of net rentable square footage of storage. And you kind of back into what's a fair number. And historically, if you're below 10, people feel pretty good. That number has been between 7 and 10 for many years. We actually looked at the correlation between supply per capita and rent per square foot. And we found something pretty interesting where below 8, so if supply per capita is between 0 and 8 in a market, correlates to strong rent per square foot. But right when supply per capita is over 8, there's actually no relationship between rent per square foot and supply per capita. And I have this chart that I'll show you
Over
after.
8?
Over 8, there was no relationship that we were able to find looking at, I think, the top 80 markets, top 80 MSAs in the United States. And what does that tell you? It tells you that in really dense urban markets, it matters a lot more than if you're in secondary and tertiary markets where, hey, something like what new homes are opening up down the road from your store, that's more important. What new commercial activity is coming into the market, that's really important. Traffic counts, are you on a good road with major frontage and high visibility? How competitive of the market is it very REIT heavy or is it, not really institutional heavy, so you're not facing all of this intense revenue management strategies. So in the really dense urban markets, supply per capita matters a lot. But when you're looking at other markets where I would posit a lot of first-time buyers aren't buying in downtown Manhattan, they're not buying in LA proper, right? You're probably looking at the secondary and tertiary markets because I'd posit there's more opportunity there because it's pretty much, these are neglected markets by a lot of institutional groups.
Traffic, competitors, what were the
Housing.
Housing, yep. We
Commercial
got
data.
housing value, commercial data. And you found that was a good one? And when you say commercial data, what do you mean there?
Yeah, so think about it two ways. Commercial activity could be, is there a new Walmart opening up, right? Is there new businesses opening up? Is there new industrial? Is there new office developments? All of those things are interesting to know what investment is flowing into the area. But also, about 15% of self-storage customers are actually commercial businesses. And those are probably some of your best customers because they pay on time. They might pay the highest rates because they're businesses. They might use it for a long time because that location's probably close to where they do their work. So all of those factors are things I ignored many years ago that paint a really good
in square foot per capita, right?
It was
That's
a
what
lot more
everybody
simplistic because we didn't really have all of this data.
What about the like? This is another one that I think people talk about a lot: growth rate, population, people moving in, things like that. How important is that population as far as rents goes to growth, or no growth, or decrease?
I didn't think we'd go this deep, but I would say when people think of population growth, they're usually referring to the census estimate of population growth, right? That really has a 90% confidence score. And if you think about the weather, like weather is usually like an 80% confidence score and all sorts of things like this. But it doesn't really tell you much. Like, how do you know the census says it's 4%? Like, okay, what does that mean? How are they going off that? Well, the other thing you can do is we know that there's 4,000 apartment units set to deliver in the next 12 months. We see that project. One, you should contact the owner or developer of that and say, hey, I own a storage facility. I'll give all your tenants 30% off if they move in. But number two, you actually know that if they lease up to 90%, you're going to have over 3,000 people moving into that area over the next year or two. That's a clear indicator of future storage demand because apartment customers tend to rent storage at high frequent levels.
Yep. That's
a real data point you can look to and show a lender versus, census says it's growing 4%, but like, how do you know that? And how do you really paint a picture around the market there?
And two, one of the things that I found is and market contractions, I think the correlation between high move-ins is negative. So with rents, because I think when you take those high growth markets, what you don't realize is there is a boom in supply. So people just flock to those areas. So then when you have that population growth slow down, it's magnified at a realm. And I talk about, I have there's two underlying metrics that I look at. I look at core, what I call core demand, and then I have transitory. And the growth, the problem with this is it's really important and really big. Transitory demand, let's say you have a population of 1 million people, and it's growing, just for simplicity's sake, at 100,000, right? So 10% growth rate. That means 100,000 people are moving in. The 900,000 people versus that 100,000 people do not use storage at the same rate. That 100,000 people 80% of them may use storage, right? So that's 80,000 people. Where then the 900,000, they may use storage at 5%. So all of a sudden, when that one metric changes, that growth rate, and it goes from not 10% to 5% or less, like it shuts down, like we've seen in different market cycles, the impact on that local market is massive, because it's not a straight, oh, it's growing at 4%. That means 4% of the market. No, that's not how it works at all. And they build to that number 80,000 people, right? Which in a lot of cases could be double or more what it is. And so it's not that simple. But the point being is you have to look at growth rates deeper. It's not a simple just, yes, that means influx of development. And then what number is these developments, the storage, actually built for?
That's a really good point. I think you explained it really well, because a lot of investors, I think one of the challenges that I see people do is they'll say, I want to find storage properties with a 3-mile population number above 50,000. And if you just think about that for a sec, there are a lot of cities in this country that have over 50,000 people. But what percent of those 50,000 actually will use storage? It's a really good point. And if you take some declining markets like in Louisiana or some other states, if they're declining and there's not new housing, is that really what you're wanting to look for? It's like, no, you want to find areas that are currently full, like occupancies are high, rates are trending up. You have a lot of growth heading into the market that by indicators that you can actually see with new housing and all of these. So you can quantify how many people do you think are actually in your universe that can use storage in the next 5 years if you hold this asset for that long. So I think 20 years ago, you could generally pick an area and you probably did okay in storage. There just wasn't that much of it.
Yeah.
But now in this hyper-competitive, data-driven world, you really need to go this level deep to protect yourself. And one thing you also mentioned is new competition, where, that was one other issue I faced as an investor of like not knowing who was opening up around me. I say to people, there are two big ways to lose in self-storage. The first is to overpay and overlever. It's really hard to come back from that. But the second is to miss when a competitor opens up nearby that you didn't know about, you didn't plan for, and they are aggressive in leasing up their property. That's a huge problem that, we track over 5,000 developments. It's something we try really, really hard to get right, to protect people from investing in areas that are about to have a bunch of new supply.
And that's the thing with even high growth markets. Most of the competition coming in are good. So when you look at these boom cities, a lot of this is REITs, private equity groups that have huge, wallets, and they have staying power. And lots of times too, they're buying market share. Like that's something we've seen a lot of. Like they're coming in and they will build to like take market share and almost to ward off others. And when you're in that environment, how much growth does there have to be to make up for those things? So I think that boom markets are also bust markets in a lot of sense. Even if the economy doesn't necessarily bust, certain industries and everything can suffer. And I'm not saying that storage is busting in those markets, but it's amazing to see how rents went down in those markets compared to third, fourth tier markets. And they're like, rents didn't go down at all. Now, they may not get the other side of it, but you got to be careful. This comes back down to the correlation of rent growth. So if you find a metric, once again, people moving in, and that correlation, you say, oh yeah, that's a good correlation, it's high, then you have to look at the opposite side of it. What happens when it's not there? If you have traffic count and the roads change and you're no longer on your way to the freeway and everybody diverts, right? How would that change? Competitors, who is moving in, how much, right? All that kind of stuff. This is the commercial data you're looking at. So what we're saying is the correlation is what's important more than the number itself. We look at what are the important data points, which I think you've nailed, a lot of these. Home income, home value, supply per capita under 8, high correlation, over, no correlation, traffic count, where you're located, right? Competitors, commercial data, housing starts, multifamily starts. You put those things together and you look at the correlation. So, right, they can help each other or also signal to you there's a problem. You got multi-housing and housing developments and multifamily starts. You think they're going to come in, but then the population growth craters. Are those starts going to still come in, or is that developer going to shelf the project, right? So understanding the correlation between them will give you a good idea of that market vitality. Is that fair?
That's fair. And I think if you're listening to this and you're like, wow, these guys are going super deep into the data, like how is this relevant to me? What we have done at TractIQ and what we've seen the best investment companies in the world do is actually find these 5 to 7 metrics that fit with your goals, right? And your goals could be a variety of things. You want something within 4 hours of your house. You want something below $1 million, whatever your goals are.
You want huge equity appreciation. You want cash flow that's just not going to leave. You don't care about appreciation of the asset. There's a whole bunch of reasons why you may want an area and what makes it good for you and what makes it not good for somebody else.
But how this is relevant in helping you find deals in seconds is you can actually put all of this into a platform, and in a second, we will show you the 10,000 facilities in the United States that actually fit that criteria with the owner information. And now you can create an off-market acquisition strategy that actually fits your thesis. Instead of trying to just scattershot, I'm going to look at every single listing, I'm going to go compete with all these major groups on a deal. It's, the time is now to actually use data for your own benefit and protect yourself along the way. So that's one of the ways.
That didn't exist 4 or 5 years ago. And that's why we're talking about this. So you may think, oh, I can't do that. You don't have to. That's not what's expected. That's why we're talking about. That's why we got TractIQ here, because what you need to do is just understand. Okay, I get it. Home income, home value, supply, traffic stuff. That's important. So then you put it in and then it can show you, great, these are good, these are bad. And then you can decide in that market what's important, what's not, how it's affecting. And then you can look and say, okay, well, occupancy and rents. You needing to go find it, to understand it, right? That's the part that's completely overwhelming. I think even as a beginner, you're like, as long as I can see things and go, okay, I can understand. I think it's amazing to look at the stuff and say, the things that I thought were really important, how do they correlate? And then look at, all right, has occupancy and rents gone up or down in this market? Because what you want to do is ask why. And if you understand why, you're good. That's it. So it's actually about questioning to me more than knowing. You need to be able to ask the question and get data back that has some kind of understanding with it, that provides understanding to the question.
And this goes to your industry life cycle presentation about how we're now in the third phase, like this institutional phase of our asset class. It's funny, a couple of years ago, I would talk to people, older folks, and I would say, how do you know if a site is good? And they'll say, I trust my gut.
Yes.
Could you imagine saying that if you were buying a stock?
Yeah.
Could you imagine saying that in most things that you ever buy? Even buying a bottle of shampoo, there's Amazon reviews, there's all these comments, there's all this information that you have to confirm like what you're buying is actually fits your goals. And in real estate, that really hasn't existed until recently, for lots of interesting reasons, as we think of AI and large language models and, public data and all sorts of things. But we're now at the point where if you're not utilizing this data, you're prone to making errors because it's just not as easy and not as simple as it used to be, decades ago.
Yeah. You could have bought anything and it went up. It didn't matter. Like, we had a bull run where everybody won, even poor performing facilities, poor locations, everything. Everybody won. You didn't have to do anything to win. You just had to own. That's it. If you owned, in fact, your flaws, you may have low occupancy, low rents, actually to somebody looking at it during that cycle was a positive. They wanted to buy
They can manage better.
And so all of a sudden you're like, everybody just makes money. So that idea that the market will make you, like I call that real estate investing, right? The invisible hand. I buy it, I can cover my debt, it can cash flow, and then I can sell it in 10 years, right? That traditional mode of thinking, that worries me because it's not that simple. And when you look at it, you're gambling. You're just betting. And that is not what we teach here. You don't bet, right? So we don't gamble, we don't bet. We can hope and pray, but that's not a strategy, right? We want evidence-backed decisions, and we want to understand because that helps you get better at everything else. Now, what you need to realize is a lot of this stuff is prevalent in first and second tier markets. It's not outside that still. So that is a huge competitive advantage for a lot of markets in the United States, which allows you to perform even better. But obviously, you need the tools and the data. So with that, dude, because we could talk about this stuff for the rest of today. I love this stuff. But where can people go to access this information, to understand it, and utilize your tool?
Yeah, you can go to TractIQ.com, which is TractIQ.com. And we actually have a page for SSI. So if you do TractIQ.com/SSI, there's a special discount for all SSI members, and it includes a free trial with the program. So if all that we've talked about today wasn't true and the product actually wasn't as good as we're hyping it up to be, then you can just cancel at any time. But that's how you can check this out. And I'm on LinkedIn all the time at Noah Starr posting stuff and always go to conferences, and really appreciate you having me on.
Thanks. And you're going to be with us at our conference in the fall, right?
Absolutely.
Okay, good. We'll be speaking on this, which will be really, really important because of this busy season and the cycles we've been to get data to talk to everybody about. We're really excited about this conference. It's going to be, we've changed. Like self-storage is coming back. It's had a rough patch. So you'll be there. You'll be talking with us. We get a look at, the information you'll present and give us more insight to the market and what it's doing. Make sure everybody are there at the links in the bio and also the link to TractIQ. Appreciate it, man. Thanks.
Thanks, AJ. This was awesome.
Dinosaurs, too, are the most, if you tracked every single asset, they are the most consistent. They've appreciated more consistently. They've never gone down. Never. And it's obvious. You're like, there's only so many.
How many is there?
Exactly. You're like, to get like Sue, Sue the T-Rex, they're like, this is like, we've never found a T-Rex like this ever. It's the only one that's that complete where it has that many bones. So you're like, it is literally once in a lifetime. Yeah. The dirty secret of dinosaurs that people don't know, what you see in museums are not real. So the public does not get to see real dinosaurs. There's some of them that are real, but
this is real.
It's real. This is real. Yeah. So what they do is they make the replicas of the dinosaurs, and they're really good at the replicas. Like they make them like exact. But Sue is one of the ones like that you saw is one of 4 replicas of Sue that travels around and generates money, but it's not real. And so they are locked up in ginormous vaults where only archaeologists get to see them. Everything else to the public's faith. Yeah. And so when people are always like, that should be in a museum for the public to see, I'm like, that's not how it works. They don't get to see. No one would ever see this. There's 7 more They're not even on display ever. They have one in London that is fake. It's a replica of one that's on. That's the only other one even on display. And it's not real. And then you get into crazy stuff too, which like with dinosaurs, it was amazing to me and a little disappointing because you found out like all these dinosaurs that we think we know and stuff, and you look at them, you're like, we don't have like any ones. Like they're like, we found a pinky. And that's it. And then they
blow it up. Yeah.
And then 5 years later it changes, and then it keeps right. It's 99.999% just guessing. So the ones that are fully intact and stuff like they have this, that's really special because we know, right? And that's rare. Well, I mean, we don't know, but you can see it. They can see the body. They can put them together, and you go, we have all the bones.
Right.
So we at least know the shape, things like that. But in even that, there's obviously massive guessing going on. In most dinosaurs, it's not like that. It's like the creatures we see on TV, stuff like that. They're guessing at 90+% of everything.
They'll have like 5% that are real replicas, and they'll use that to like predict what this other model
what it may
species
look like.
would look like. Yeah.
Yep.